Hello everybody, my name is Joe Robinson and I'm a real estate agent with Wycott Realtors in Locust Grove, Virginia, and this is part 2 of the Q&A session with Austin Redmond of SWBC Mortgage. Thank you for coming back and doing this again.
Of course, glad to be here. Let's do it.
Okay, for today's segment, our first question is, what is mortgage insurance?
Yeah, so mortgage insurance is another aspect of a loan used to protect the lender or the agency that might be insuring your loan. There are different types. For a conventional, it's private mortgage insurance. For an FHA, it has its own type of mortgage insurance. So I think this is where the 20% down payment, rule kind of comes in, or myth kind of comes in a lot. If you do put under 20% down, you are going to be required to pay mortgage insurance in some sort of way. You can pay it kind of upfront, you can pay it in the rate, and you can pay it in the monthly payment. And each of those has its own consequences, or might vary, whether it's how much money you bring to the table or your monthly payment, but you will pay it in some way.
Thank you. And our second question for today is, in addition to down payment, what are some of the other costs that the buyer will be responsible for at closing costs?
Yeah, so like you said, the term most associated with that is closing costs, which is your lender origination fee, which may be charged. That includes your appraisal fee, your flood cert fee, different things like that, as well as your title fees. And then that also includes your taxes. So they vary a lot by the type of home you're buying, where you're buying, what day of the month you're closing. You might have more taxes due. So yeah, it would vary a lot, but I would say it's about 2% of the overall loan amount usually.
Thank you. Our next question is, how do mortgage inquiries affect your credit score?
Yeah, we get this one a lot too. They will count as a pull on your credit, but the nice part about it is only 10% of your credit score is made up from credit inquiries. And a few years back, they also realized that people are shopping. They're shopping rates, they're shopping lenders, whatever it might be. So you have a 30 to 45 day window now that all mortgage inquiries you get are considered one inquiry, and that's nice because when you're shopping, you're not getting an extension of credit each time where it's a credit card. Every time you get your credit card score pulled for a credit card, you're looking to extend your credit even more. But now you're only going to get one mortgage, so that's kind of nice that they did that for the borrowers, and definitely does not affect your score too much.
Our next question is, you probably get this a lot too, is what is your rate, and your rate versus payment?
Oh yeah, that's the big one. What's your rate? I always say that it's more, your monthly payment's more important than your rate, obviously, because I can show you a 4.5% rate that actually might have a higher monthly payment than a 5% rate. That's all due to usually the mortgage insurance that's in there, because that mortgage insurance in your monthly payment can really drastically change your monthly payment and actually be make that payment more expensive than a higher rate. So everyone, like I said, everyone's kind of obsessed with that rate number, but when I'm looking, or an individual looking, I always stress upon the importance that it's really the monthly payment coming out of your bank account each month is the most important part.
And our last question for today is, how do escrow accounts work?
Yeah, so escrows are used by lenders to help the borrower pay their taxes and insurance. So instead of collecting just your straight mortgage payment each month, they actually include those taxes and insurance, and will disperse those funds for you. We like to consider it's a bucket. So you're actually just paying into a little bucket that we hold on to, and then when your tax and insurance are due each year, we'll pay those for you and go from there.
And why do lenders do this? Why not just let the homeowner do it themselves?
Yeah, there is an option where you can waive it, and some people do that. I would say about 99% of people don't do that, but it's all to make the process easier for the borrower, just because it is easier to make one lump payment and not have to worry about dispersing the taxes on time or whatever it might be. And that also keeping track of those, it's another kind of budgeting, which most people don't like doing. So try to make it a little easier for the borrower and go from there.
Thank you so much, Austin. That was very informative. That was part 2 of our Real Estate Q&A. Thank you so much for doing it.
Thank you.
See y'all soon.